All right, let's get into it. Today we're going to talk about a trading strategy that, well, it's kind of boring. But boring, as we're about to see, can be incredibly profitable. We're going to break down how a super simple, mechanical approach pulled in tens of thousands of dollars in just 1 month.
So check out this quote. It really hits the nail on the head. This trader, J-Dub, tried all the complicated stuff, everything under the sun. And where did he land? On simplicity. The point isn't to be a wizard who can predict the future. It's to have a repeatable process, something you can execute over and over without second-guessing yourself.
And look, the proof is in the pudding, right? We're talking over $44,000 in actual realized profit in a single month. That's a 50% return on the account in about 30 days. It just goes to show you, effective and complicated are not the same thing.
Now, here's the thing. That huge profit, it wasn't about being right all the time. The real magic is right here, in the numbers. A 66% win rate is great, for sure. But the killer stat is that the average win was more than 2.6 times bigger than the average loss. That positive edge, that's the engine that makes the whole thing work long term.
So what's the secret sauce here? What's the foundation of this whole thing? Well, it all comes down to one simple, elegant concept that's behind every single trade they take.
Okay, so the whole system is built on this one idea, the break and retest. And it's not about being a psychic, predicting the future. It's about reacting to what the market is doing right now. You find a key price level, you wait for the price to punch through it, and then, and this is the most important part, you wait for it to come back and tap that level again. That retest proves the old ceiling is now the new floor, or vice versa. You're just reacting to that confirmation.
And the best part? You only need to learn 3 specific patterns to apply this concept. That's it. 3 building blocks for the whole system.
So here they are, the opening range break, the previous day high/low, and the order block. Now, at their core, they're all just different flavors of that same break and retest idea. The only thing that's really changing is what kind of key level we're paying attention to.
All right, let's start with the opening range break. This one is all about capturing that first big push of energy right when the market opens. All you do is draw a box around the high and the low of the very first candle of the day. That little box becomes your first battleground.
And this is what makes it so smart, so low risk. See, when the price breaks out of that box, you don't chase it, no way. You patiently wait for it to pull back and retest the edge of the box it just broke. You enter right there, and your stop loss goes right on the other side. It gives you this really tight, defined risk for a potentially huge reward. It's beautiful.
Okay, the second setup has a zoom out a little. We're going to look at the previous day's high and low. Think of these as major landmarks from yesterday's trading. They're the most important reference points that everyone in the market is watching from the day before.
And because these are daily levels, man, they carry so much more weight. They're like these big psychological lines in the sand for the whole market. A clean break and retest of one of these levels can signal a really powerful trend continuation. On the flip side, a hard rejection can be the start of a major reversal.
All right, last one, the order block. Now, this might sound a little technical, but the easiest way to think about it is like finding the footprints of the big money, the institutions. In a strong downtrend, you're looking for that last little green candle right before the price fell off a cliff. That little candle often marks a hidden zone of sellers. So the play here is super straightforward. You just wait for the price to wander back up into that little zone. If it hits that spot and stalls out, showing you that the sellers are still there, boom, that's your entry signal to get short and ride the trend down, with your risk clearly defined right above that zone.
Okay, so theory is great, but let's see this thing in action. We're going to walk through a real trade on Tesla, a trade that combined these ideas and pulled in $12,000.
So what made this trade so powerful? It was something called confluence. It wasn't just one setup. It was 2 of them lining up perfectly at the same time. You had the big picture context from a major level, the previous day's low, and then you had the sniper entry from a small picture pattern, the opening range break.
So here's the play-by-play. First, the big picture context. Tesla shot up right to the previous day's low and got slammed back down. That's a huge clue that sellers are in control. Second, the signal. On the tiny 1-minute chart, price broke back down through the opening range. Third, the entry. They waited for a little bounce back to retest that opening range level, and when it failed, they got short. And the result? A massive, clean drop for the rest of the day.
And that all boils down to this one number, 6.75R. So what on earth does that mean? It's simple.
For every single dollar you were willing to risk on that trade, you made back $6.75. That is the kind of math that can make a simple strategy wildly profitable over time.
So, this all brings us to the big question, right? The most important takeaway. Why does being boring actually win in the long run?
Well, just look at the difference. On one side, you've got the complex stuff, trying to be a fortune teller, guessing where the market's headed, staring at a million indicators, and making gut decisions. And on the other side, you have this boring strategy. You're just reacting to what the price is already telling you at key levels. No fancy indicators, no guesswork, just mechanical execution.
And that really leaves us with this final thought. We so often think the answer to getting better is to add more stuff, more indicators, more complicated rules. But what if the real secret to becoming a consistent trader isn't about adding more at all? What if it's about having the discipline, and maybe even the courage, to strip it all away?